Mr. Jayakumar, thanks so much for joining us and talking to ET now. Now, firstly, okay, let me get the pain out of the way, if you will. Quarter 3, when you came out with those numbers and the commentary, everybody on the channel came and said that this is exemplary. It is now virtually a zero NPA bank because they have taken the entire hit in quarter 3, and now you value the bank for what it can dish out quarter 4 onwards without there being any other skeletons coming out of the cupboard. There is a bit of a mix out here in quarter 4. What explains this?
Well, it is like this, fundamentally we have had a good quarter and a reasonably decent year because the balance sheet and have grown and our collections recovery has been quite outstanding. The decision to move with a higher coverage on PCR was largely in response to feedback from a lot of analysts who said that at a 50-51% coverage you're not adequately positioned. So you take feedback into consideration. We also went back and looked at it and asked whether the coverage is adequate. Now it's very difficult to pin a precise number, but a higher number is better than a lower number. And in all of these things, what happened in the meanwhile was the rules relating to capital adequacy fundamentally changed, and there's a lot of changes there, and we got a huge uptick on account of that. So that gave us a freedom of action to take a higher provision on the NPA, which is beyond the requirements of the IRAC or the RBI provisioning. So if you X out the fact that we took what we can call as discretionary provisions and match it against the loss, we actually end up making 1,600 crores of profit. The other provision we took was with respect to employee cost. There was a need to shift to the new table of mortality, something that could have been done a couple of years before, but never mind, we decided to do a full-time catch-up on that. Third, we had a bunch of issues on tax and was reflected in a contingency statement of about 1,400 crores of items under discussion with the tax authorities. A lot of good work done by our team, and they brought it down to about 400 crores. And this quarter we decided to provide for the 400 crores, notwithstanding the merits of a claim. Right. So if you add all of this, we took nearly 3,000 crores on 2,800 crores on NPA, 1,600 crores on provisions, and 500 crores, 400 crores on the tax, adding up to about 4,800 crores, 5,000 crores. Now listen, reality doesn't change whether we take the provision or not. Right. And the reason we did it was, and we always maintain that whenever we get exceptional earnings, we're going to use that to strengthen the balance sheet. This time the exceptional earnings did not flow through the balance sheet, but flew directly into the capital line. And for us it was the same thing again. So look at it this way, taking the provisions, doing all of that stuff, and yet the capital adequacy ratio being nearly 1% and odd over and above what was there in the third quarter puts us in a very strong position.
Yeah, it does. My question is one is this, I think it's prudent accounting as well. I mean, when there's stress in the system, why show profits just for the heck of it? But my question to you is this stemming from the fact that the future ahead remains uncertain as well? Or are you being opportunistic that you will do it no matter what, even if the economy were to pick up? If you get a chance, you will probably go ahead and increase provisions because you want to take your provision coverage ratio higher.
Let me tell you what I like to do, which will not be the same thing as what will eventually happen.
Okay.
In general, higher the provision coverage or lower the net NPA number, the better it is. This time our net NPA number has gone down by about 40 basis points. But the absolute amount of NPA not provided, forget the percentages, because denominators you can put some more money, you can lend more, you can lend less, but doesn't change the risk. The risk is really lying in what is not provided, that has come down. If I had an opportunity, we would take it even more. But is this adequate? The answer is yes. Should we provide more? That's what any prudent man would do. Now, the position on, just going back again into why we took the accounting this year, an analogy could be if you're a trader and you're running a large portfolio, making money, you would use the opportunity for any asset that was below its investment market price and exit them out. So that's what it is. So I think we have done what is right. And that is what
There's no saying this will not continue in the future.
Let me tell you this way, we had yesterday disclosed far more detailed granular number with the analyst.
Yes.
What we shared with them was that the principal risk comes from two lines, the restructured asset on one side and the SMA2 on the others. These are customers who are between 60 to 90 days overdue.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.